very much, Ariadna, for thank you, Ariadna, for this quick introduction. And hi, everyone. I know I had the opportunity to talk to, I think, most of you already. So it's I'm very glad to see you again, even via Skype or Teams. I don't remember which application we're using, but it's always a pleasure to see you all, guys. Yeah, and Ariadna asked me to do a presentation or to present something that address transfer pricing, and especially, of course, transfer pricing in France. And to be entirely honest with you, when Ariadna asked me to do so, I was a bit puzzled because I didn't know exactly what to talk about. I realized that there is no specific transaction currently on the radar. There is no just one single issue, but then I realized that it's the entire transfer pricing arena that is currently boiling in France. And it's not just one type of transaction on the radar, it's a bunch of transactions on the radar. And then I realized that, yeah, well, actually, that could be a good topic to talk about and to discuss with you guys, because indeed there are things deeply changing in the French transfer pricing arena. So I know I only have like 20 minutes or so to discuss this, so I'll try to make it quick. First, just to give you a big picture, of course, it's no surprise to you, I'm quite sure, but transfer pricing is a very hot topic in France, not only because the French tax administration, the FTA, is very aggressive, but I'm sure you already know that. But when we look in the rear mirror, we realize that transfer pricing has just skyrocketed over the past few years. From a statistic or analytic standpoint, I just put I highlighted some numbers. As you can see, there were, of course, fewer tax audits in 2020, and this is due to COVID, because the tax inspector, they are working from home, meaning they were not working at all. I mean, let's face it. So there were no tax audit or almost no tax audits in 2020, but yet the few tax audits that took place, they generated as many adjustments as in 2018, which means a lot of adjustments. And the reason is that these adjustments, these tax audits, they are now better focused. They clearly are focused on transfer pricing, and within this transfer pricing arena, I will come to it, they are focused on certain type of transactions and issues. And the tax inspector, now they are more and more familiar with these transfer pricing topics, issues. For example, they are better trained when it comes to financial transactions. They can read English, which is which was not the case some years back. But now, if you communicate a transfer pricing documentation written in English, they are in a capacity to read it and to understand it and to digest it. So more and more adjustments, meaning also more and more tax penalties. So it's not only about transfer pricing adjustments per se, so adjustments in the field of corporate income tax, it's also more and more penalties that are linked to these reassessments. And typically one is almost always triggered is the bad faith penalty. The bad faith penalty, in a nutshell, it just adds a 40% layer on corporate income tax and any other ancillary taxes generated by transfer pricing reassessment. And because the French tax administration only says that, all right, guys, you're part of a group. Of course, you perfectly knew, or you had the knowledge to understand that what you are doing in your transfer pricing policy clearly does not reflect arm's length standards. And it's, to me, I think it's very dangerous, because of course you never had a crystal ball. You never know for sure whether or not your transfer pricing policy is set at arm's length. And it's very subjective. I mean, it's not just a black or white type of answer, you know that. So it's a bit straightforward, and I must say a bit narrow-minded in the way they think, but that's the way it is, unfortunately. More tax inspector. Just for your information, there were a bunch of tax inspectors sent to the Netherlands and the UK to be trained to transfer pricing aspects, and of course in English. So again, they are really much better trained. And in this transfer pricing environment, it's not only about the French tax administration, it's also about the French regulations that echo transfer pricing standards, and especially the OECD standards. And just for your information, as part of these 15 BEPS actions, 14 of them were already implemented, translated into French tax law. So basically, we now have French international tax environment that clearly is OECD compliant, but that completely reflect the latest BEPS actions and standards. Talking about BEPS on the OECD, as I mentioned it on the slide, there was an immediate adherence to the BEPS works and action. You know that the director of Center for Tax Policy, Pascal Saint-Amand, is a French guy, and he originates from the French tax administration. So of course there is a direct link between the high levels and the hierarchy of the French tax administration and the OECD, thanks to Mr. Saint-Amand. France was also one of the very first country to adhere and try to implement the digital tax. As you know, it's a country that immediately signed the multilateral instruments and changed very rapidly its tax treaties with the other countries. It's very active when it comes to Pillar 1, Pillar 2, etc. So again, just understand that even though, of course, 5 years from now, we already made reference to the OECD guidelines. Now it's as if the OECD guidelines were integrated into rock solid French tax law. With everything that this entails, because you know it as I do, the OECD standards not always reflect crystal clear standards and rules, so it's always very subjective, very puzzling when it comes to, for example, functional analysis, etc., etc. Last but not least, I was talking about regulation. It's not only about the law, meaning the articles of the French tax code. It's also about what we call the administrative doctrine. So basically the standards recommendations released by the French tax administration. We see more and more of these releases addressing transfer pricing, and again, referring to the OECD guidelines. But there is another signal, which to me is very important. It's the number of precedents, judge-made law. 5-10 years ago, transfer pricing, of course, it was something that never really hit the administrative courts, because it's very time consuming. You never know whether you will win or lose. And of course, in 90% of cases, the adjustments yielded to arbitration or settlements. It's no longer the case. I don't know if it's a good or a bad thing, but we can see more and more precedents with the courts more and more judging in favor of the French tax administration, which also is very new. In the past, I would say 90% of cases were in favor of the taxpayer, and now the balance is a bit, I would say, more equal, because we see more and more precedents in favor of the French tax administration, even though, again, the entire background or the facts are not so different as compared to these precedents I was mentioning 5 years ago. So that clearly shows that even the tax courts, they are more rigorous when it comes to transfer pricing, and they tend to favor the French tax administration. So that's the big picture. And in this environment, I just wanted to present you the main changes that I detected in this French tax arena. There is, I would say, the first section that I would address, what I call the new paradigms. It's true that there is a clear change in the mindset of the tax administration, of course, but even the practitioners and myself specifically, but I will come to it. There are some transactions that are under the microscope. In the introduction, I mentioned it's not about just one type of transaction. It's true, it's just a bunch of transactions. If I had to find a common category, I would say it's all transactions not linked to something tangible. So all the tangible flows, the tangible flows in the meaning of financial transactions, intercompany loans, cash pool, etc., etc. Services, of course, but also everything that touch upon intangible. I was about to say assets, but it's no longer about assets. It's more and more about intangible items. Let's put it this way, or what the American referred to as something of value. So something very blurry, very broad, but we're heading toward this. And last thing, I just wanted to address that as well. More transparency, that's for sure. As you probably know, tax, and especially international tax in France, unfortunately, it's a very dogmatic topic, meaning that most people have the impression that international cross-border flows, let's put it this way, cross-border transactions are a mean to pay less taxes. You know that it's much more complicated than that, unfortunately, but that's, I would say, the common mindset in France. So in order to address that, most politicians and rules makers, they are in favor of more and more transparency to try to capture each and every transaction and understand what is at stake, which to me is very, very dangerous, because you can't have Mr. Anybody having a look at your CBCR or transfer pricing documentation. It doesn't make any sense, because they are not in a capacity to understand what is at stake. Yet they will criticize what is at stake because they say, oh, well, there's something going to Switzerland. Well, again, it's more complicated than that, I'm afraid. But the first section, the new paradigms, to make it quick, basically, there is, first of all, a clear shift of the burden of proof from the French tax administration to the taxpayer, which is very awkward, because legally speaking, Article 57 of the French tax code, which embeds more or less the arm's length principle, it echoes the arm's length principle, to make it simple. Theoretically, it puts the burden of proof on the French tax administration. The French tax administration has to demonstrate first that there is something not reflecting normal situation or arm's length situation, and then it's the taxpayer to demonstrate that everything is clear, that everything is normal and indeed arm's length. Yet, because of the introduction of the Action 13 of the BEPS action plan in the French tax law, as you know, as part of the transfer pricing documentation, the taxpayer is required to provide economic analysis sustaining or supporting the arm's length nature of the intercompany transactions. And here it's very puzzling, because now the taxpayers have to provide such economic analysis and then ensure that they, of course, will ultimately fall within the arm's length range. That was not the case previously. But that also means that as part of a tax audit, the French tax administration does not need to do much. They simply now ask for the transfer pricing documentation, they review it and say, well, guys, I don't understand. You, as part of the tax document, the transfer pricing documentation, you performed an economic analysis because you are required to do so. And if you don't, of course, you are facing some penalties. So you are required to do so. In this economic analysis, you say that you should normally derive, say, 5% operating margin or whatever, and you do not fall within the ambit of this arm's length range. So there's something obviously puzzling. And then the complete burden of proof is shifted on the taxpayer, which again, to me, is something that should be illegal, yet it is admitted by not only the tax administration, but now by the courts. I've seen situations where we prepared some economic analysis trying to test, for example, the gross margins, and then the tax administration said, okay, I'm not keen on testing the gross margin. I very much prefer net margins instead, but I will then recycle your set of comparables and then calculate a profit level indicator based on or yielding to net margin instead of gross margin. So again, they're just recycling what we or what the taxpayer did. They could also eventually just change it. Just say, okay, as part of your set of comparables, I will reject this one, this one, this one, but then I will try to reintegrate this one and this one. And again, this will completely change the complete picture. But again, it's on us, taxpayers or practitioners alike, to then demonstrate that the French tax administration is wrong, which is very, very hard, because if you provide in the first instance the set of comparables, it's very hard then to say, well, but this set is not perfect. We should redo it and try to communicate a corroborative economic analysis. Of course, it doesn't do the trick. So that's very, very puzzling. One last thing also, they have seen situations where the tax administration not only recycled the set of comparables, but will then change the transfer pricing methodology, which again is very, very puzzling, because then you have a bridge, of course, between the functional profiles of the comparables and the nature of the transfer pricing method that you will apply, from, for example, a cost plus to not only a net cost plus, but why not change it from a cost plus to a resale price method? I've seen that. And again, that puts the taxpayer in a corner, and it's very, very complicated to get out of this situation. So we are waiting for some new court's decision. Myself, I've brought a specific situation before the courts, and I've asked the court to tell us whether or not we are okay with this burden of proof being shifted on the taxpayer. I'm afraid I won't have the decision before the next 2 years. I will, of course, let you know. But this is, again, very, very puzzling, because it's a complete change in the legal mindset applicable in this transfer pricing environment. A shift in the burden of proof, for sure. I mentioned the TNMM or profit-based method. That's also something more and more common. Of course, you won't be surprised to know that in probably 90 or 95% of cases, the French tax administration applied the TNMM. It's easier, and fortunately, in doing so, most practitioners now are used to applying the TNMM as if it's a reflex. And of course, it's not. I mean, we need to think twice and evaluate whether there is another method more appropriate. But most people now think that the TNMM is the one and only method to apply. But it goes even beyond that. From the TNMM, the French tax administration then applied some kind of a CPM, the US CPM method, meaning they are not delineating the transactions, they're just applying a global TNMM. I'm taking the tax payer complete P&L, and I'm just calculating a net margin, either a net cost plus or an operating margin, without segregating the transaction, the intercompany transactions. And from then shift more and more to a profit split method, because the OECD says profit split is the new TNMM, orange is the new black. It's a bit the same thing. And the French tax administration wants to be modern. They want to be contemporaneous. So they say, okay, the OECD says more profit split method. Me, as a French tax administration, I will apply more profit split method. And in fact, from a global TNMM situation, they somehow apply a profit split method, because if you leave in a bilateral transaction, of course, if you leave a target margin to one entity, that means that all the residual will then be passed on to the other party. So it's a bit like a profit split method already, but then because of these BEPS initiatives, Action 8 to 10, this equilibrium between the functional profiles, the French tax administration now think that it's probably the best method to apply. And we see more and more cases where indeed the French tax administration applies this profit split method. It depends on the tax administration's team, I must say. As you may know it, there is some kind of a hierarchy in the French tax administration. On the upper layer, there is a team called the DVNI in charge of assessing the large multinationals, and those guys know they are in favor in favor of the profit split method, whereas local tax inspector, we can still see some of them trying to apply the TNMM, global TNMM, let's put it this way, but I also see some attempt to apply the profit split method. So more and more, I think we'll need to use this method only, unfortunately, which to me is a problem because, as you know it probably from experience, it's a method is, I think, a bit complicated to apply because it's really based on subjective aggregates. It's not a straightforward methodology to apply, and I'm afraid that currently the French tax administration is not sufficiently familiar with let's call it economic features to be very rigorous when it comes to applying the profit split. And one last paradigm I wanted to mention, maybe for you it's a given, but it's not for us. As you know, France is a written law country, meaning that normally a contract is more important than substance, to make it simple, or at least contract vests a very, very high importance. It tends not to be the case any longer. France is really heading toward a substance over form type of method or mindset, as if contracts no longer have any importance. And we can see it, of course, in the DEMPI environment when it comes to intangible assets. But we can also see it in any other type of transactions where the French tax administration, of course, asks to be provided with the legal agreement, but more and more they say, okay, what is written in this? Okay, I will confront it with the reality. So the functions being allocated, the risks being borne. And if they realize that there is a bridge between the contract and the reality, they would just simply reject the contract and say, okay, guys, no, let's be honest with one another. Which again, from a legal standpoint, is very puzzling because normally the French tax administration cannot do it, or at least not, it's not that simple. There is a very specific procedure for the French tax administration to consider that they need to reject an agreement, and that's a very burdensome and cost-consuming procedure. But more and more, and notably thanks to the support of the administrative courts, the French tax administration no longer uses this procedure, and they directly pretend that the agreement does not reflect the reality, and they just reject it, and it's that easy. So again, it's as if France was passing from a situation where it is a written law country, and it has been the case for the last 200 years, and they are shifting towards a common law, very liberal type of country, like we see in the US or in the UK. And again, I'm just trying to make it simple, but you certainly understand what is at stake. They are completely changing the way they approach things and the way they approach ownership and the attribution of responsibilities and terms and conditions and everything that can be found in an agreement. So here again, this is very puzzling. It's if I had to summarize it in just a few words, I would say that France now wants to behave like the IRS or the HMRC without being that strong or without being sufficiently familiar with those transfer pricing and economic aspects. So it's a ticking bomb, clearly, because you can't change that mindset without having the tools to appropriately assess transfer pricing or economic situations. Again, I'm just making it quick because I know I only have 20 minutes. Transactions under the microscope or on the radar as I was mentioning in the introductions, there are two types or three types of transactions, I would say. Financial transactions, that's a given. For a very simple reason. There is one article in the French tax code, the 212, the one that I mentioned, that sets a publicly available interest rate. And the tax inspector, and the law basically, said that as long as you reflect that public interest rate, everything is good. Everything is exactly as if this rate was a safe harbor. Actually, it is a safe harbor, in fact. But if you deviate for whatever reason from that public interest rate, then the full burden of proof lies on the taxpayer. And you know, guys, that it's very complicated to build a rock solid demonstration of the arm's length nature of a financial transaction, because there are so many aggregates to take into account, so many parameters to use, the calculation of the credit rating, the use of external databases, etc., etc. You never can end up with a crystal clear or one single answer. This is exactly why we use ranges. But as soon as we use ranges, the response becomes a bit subjective. And that's exactly what the French tax administration tends to oppose to us. They say, well, I'm not convinced. The burden of proof is on you, yet you fail to convince us that this interest rate clearly reflects arm's length standards. So in, frankly speaking, 100% of cases, or the latest cases that I've been confronted to, I can tell you the French tax administration always audited and reassessed the financial transactions, even for small amounts. But that's a piece of cake for them. Even for very small intercompany loans, if you deviate from this publicly available interest rate, then you can be sure that you're heading to a tax reassessment. And there were a series of landmark cases that I did not list the full did not mention, sorry, the full list of these cases, but I got them at hand. There were some court decisions released those last couple of years, 2 or 3 years backward, and they provided us with several signals, parameters to take into account. It's good to know now that bonds indeed could be used as decent references or comparables when it comes to economic analysis. It is good to know also that, yes, we are allowed to use rating softwares like RiskCalc, for example, whereas the French tax administration previously said, no, it's not a proper reference. But still, even though the judge and the courts said that, yes, you can use bonds, yes, you can use external softwares, yes, you could use corroborative methods, etc., etc. Yes, the economic analysis does not need to be contemporaneous with the date where the financial transaction has been entered into, even though, again, the whole thing is very subjective. And unfortunately, in most cases, the taxpayer loses and then has to pay a reassessment. That also causes a breach in the, I would say, the taxpayers' capacities to avoid such reassessments. Large multinationals, they can pay benchmarking studies and financial benchmarking studies, which of course represent a rather significant budget. But small taxpayers, or taxpayers, for example, that apply a rate that is a bit higher or a bit lower, sorry, than this publicly available rate, they don't want to pay 10 or 15,000 euros for a benchmarking analysis. So we are having a very hard time to tell them that they are currently facing a risk, and that in case this risk comes true, they will be facing a reassessment, and again, with penalties, with withholding tax consequences, etc., etc. So it could be a very large amount of cash out for those taxpayers. But yet it's very, very hard at this stage to convince them to run proper benchmarking studies. Again, because they also know that you can't be 100% certain at the end of the day. Even though you provide a rock solid benchmarking study with a decent range, they know that the tax administration can say, well, I'm not convinced, so I reassess you. Other transactions under the microscope, those transactions touching upon intangible assets or items. For your information, there is no definition in the French tax law of what is an intangible item or asset. You need to refer to the accounting standards and rules, but of course they are not as exhaustive as tax law could be. So basically you have no definition at all in the French tax or accounting arena. And that was very, very puzzling. And the French tax administration now wants to replicate these OECD standards, and they no longer refer to intangible assets. They much better prefer intangible items. And what we can see in reality is that they try to reassess whatever item has a value attached to it. So they basically fall within what the Americans call the something of value type of mindset. And they tend to see value basically everywhere. Marketing intangibles, reputations, the network, the capacity to develop more sales, etc., etc. They see intangible items in each and every intercompany transaction, and this completely changes your functional profile, and therefore your transfer pricing methodology, and therefore your set of comparables. If from the situation where you think you were facing a limited risk distributor or a full-fledged distributor to a situation where the French tax administration says, no, guys, in your relationship, there is something of value being shared. So you can't pretend you are a limited risk distributor, but you are, again, a full-fledged distributor, or you think you are a full-fledged distributor, but because you have control over something of value, then it makes you, I would say, a bigger profile. I would not say an entrepreneur, but almost. Again, the French tax administration then will say, okay, I will not adhere to the transfer pricing methodology that you applied, but I will shift to another methodology, or again, why not the profit split method? So that's again also very, very puzzling. Not mentioning the fact that if they consider that there is some kind of an intangible item at stake, they may also try to look at the tax treaties binding the two countries to check whether such transactions addressing an intangible asset would not trigger a withholding tax. It's a bit tricky, frankly speaking, because usually the tax treaties, they are quite crystal clear when it comes to qualifying for a transaction involving an intangible item. Usually you have a withholding tax in case there is a license of, say, patents or brands or other types of intangible assets or rights, intangible rights. But again, the French Constitution, I mean, they're trying it. They're trying. So they will reassess first and they will discuss then, which is never the best situation. The Dempsey analysis, yeah, this is something we see more and more, even though, as I was saying 5 minutes ago, I can tell you the French tax administration, they are clearly not familiar with those standards, but they are replicating things. They are copying and pasting boilerplate text that they've seen somewhere else, but they try to reinvent the transfer pricing topic and arena. The ex post analysis, that's something also that I wanted to mention. Again, in our written law mindset, you can't apply an ex post analysis. It doesn't make any sense because normally the parties to a transaction, they are trying to replicate arm's length standards. At least normally it's on the FTA to demonstrate that it is not the case, normally. So basically you can't, 3 years after the transaction took place, try to reinvent the whole story. Well, as you know, the OECD encourages this ex post analysis, and now the FTA tries to implement it as well. So we will see, certainly in a very, very near future, new case laws which previously were in favor of an not the ex post analysis, but the other one. I just lost the just lost the wording in mind. Sorry, but case laws that rejected the ex post analysis, and I'm almost certain and positive that maybe next year, 2 years from now, we'll see case laws advocating for the ex post analysis, because of course precedents can be reversed. So that is something that will change also in the very near future. Services, and I will finish with this if you didn't mind. Services, it's also something that is very, very often generating transfer pricing reassessments, where a very simple reason is that most groups, they do not document their transfer pricing, the services transactions, sorry. It's not that much about the method, because the French tax administration says, okay, cost plus 5, that's good, no problem, because the EU GTPF said so, because the OECD said so. So it's no longer about neither the methodology or the markup. 5%, this is good. It is a safe harbor, clearly, but it's about the computation of the costs that constitute the cost base, the allocation of those costs, and the benefit tests. And basically, if you failed to prepare it in advance, this demonstration of the again, the arm's length nature of the cost base, the allocation of these costs, and the benefit tests, in most cases, then you are facing a tax reassessment. And then the French tax administration will simply consider that you do not need those services. So they reject 100% of the charges corresponding to these services. So again, I'm telling all my clients, it's very easy to document intercompany transaction services. So it's very easy to document intercompany services, but most groups do not do so. It's too much of a piece of cake for the French administration then to reassess. Last thing, and this will be, I think, my last slide before the conclusion, it's the race for transparency. That's what I was telling in the introduction. We see more and more documentation rules or requirements, and alike type of requirements on the taxpayers, not only transfer pricing documentation, but as you may know it, there is also some kind of a light documentation requirements lying on the taxpayers. We now have also the MDR rules, mandatory disclosure rules. We have the electronic accounting files. We have the VAT audit track requirements, etc., etc. We have more and more documentation requirements. That's a huge burden, which is completely awkward, because normally the logic would be to head towards, I would say, a more business-friendly environment, and we are doing exactly the opposite. We are just multiplying the documentation and the like requirements on the taxpayers, and that's very, very harsh not to be, or sorry, it's very, very harsh to be in line with those requirements. It takes a lot of time for the multinational enterprises to prepare these. It's very time consuming, burdensome. It's good for us, let's be honest. But still, it's getting more and more complicated. Plus, for your information, a lot of people are willing to make those requirements publicly available. This is the case for the CBCR, and I think, unfortunately, that this will be accepted soon by the French Parliament. French CBCR will be made available to public. This is it, folks. Just wanted to, in 20 or a bit more minutes to describe this environment. Again, more challenges, of course, a change in mindset. I'm just summarizing what I said, but a change in the mindset, and we can already foresee more and more reassessments, but also more and more case laws. And I'm sure, I have no doubt about the fact that if we have the same conversation 1 year from now, I will be in a position to tell you much more about what is at stake, and I will be in a position to give you some case laws and decisions and big reassessments that clearly show a change again of paradigm in the French tax administration's mindsets and methods. This is it, folks. I hope it was clear and exhaustive. But I very much enjoyed presenting those topics to you.